Welcome to the ultimate guide comparing mutual funds versus ETFs in 2025. If you're wondering where to invest your hard-earned money, this comprehensive analysis could literally save you hundreds of thousands of dollars over your lifetime. We're talking about real money here, the difference between retiring comfortably and working until you're 80. This isn't just another surface-level comparison. We're diving deep into 2025 data, performance numbers, and real-world scenarios that will show you exactly which option is right for your specific financial situation. Global ETF assets have exploded to $14.6 trillion, up 27% in just 2024 alone. Meanwhile, mutual funds still dominate with over $16 trillion in assets worldwide. But here's the shocking reality. ETFs are providing 1.05% higher after-tax returns annually compared to similar mutual funds. That seemingly small difference translates to an extra $329,031 in your pocket over 30 years of investing. That's not a typo. Over $300,000 in additional wealth from the same initial investment and market returns. This comprehensive analysis covers 8 critical areas. First, the fundamental differences between mutual funds and ETFs explained clearly. Second, 2025 performance data and trends most investors haven't seen. Third, the cost comparison that might shock you with real 30-year calculations. Fourth, tax implications that could save you thousands annually. Fifth, when to choose flexibility versus automation based on your behavior. Sixth, the active versus passive management debate with current evidence. Seventh, 2025 market innovations changing the landscape. Finally, specific recommendations for different investor types and wealth levels. Before diving into complex comparisons, let's establish clear definitions. The financial industry loves complicated terminology, but these concepts can be explained simply. We'll start with mutual funds since they've been around longer, then explore ETFs, and finally examine how the traditional boundaries are blurring in ways that matter for your investment decisions. Picture a mutual fund as a large investment pool where thousands of investors contribute money together. You might invest $5,000, your neighbor $50,000, someone else $500, creating a collective pool of perhaps $50 million. A professional fund manager takes this pooled money and uses it to buy stocks, bonds, or other securities. When you invest in a mutual fund, you don't own individual stocks directly. You own shares of the fund itself, representing a piece of that larger pool. Mutual funds have specific characteristics that affect your investment experience. They're priced once daily at a market close, called the net asset value, or NAV. You cannot trade during market hours. They can be actively managed, where managers constantly buy and sell trying to beat the market, or passively managed, simply tracking an index like the S&P 500. Most require minimum investments, though Indian SIPs can start with just Rs100 monthly, while U.S. funds might require $1,000 to $3,000 initially. They offer automatic dividend reinvestment and systematic investment plans for hands-off investing. Exchange-traded funds are like mutual funds' more flexible younger sibling. They're also pools of investor money used to buy securities, but they trade on stock exchanges throughout market hours just like individual stocks. You can buy and sell ETF shares anytime the market is open, with prices fluctuating based on supply and demand. Most ETFs are passively managed, tracking indices rather than trying to outperform them. They have no minimum investment requirements. You can buy just one share, with many brokers offering fractional shares. ETFs offer advanced trading features like stop-loss orders, limit orders, and option strategies. Holdings are completely transparent, with exact portfolio details published in daily. This transparency contrasts with mutual funds, which might only disclose holdings quarterly, and by then, the portfolio may have changed significantly. Traditional distinctions between mutual funds and ETFs are rapidly disappearing. Active ETFs are exploding in popularity, growing 20 to 30% annually. These combine active management with ETF structure benefits. Index mutual funds offer passive investing like most ETFs, often with competitive expense ratios. Many brokers now provide automatic dividend reinvestment for ETFs and systematic ETF purchasing programs similar to mutual fund SIPs. However, core structural differences persist. ETF structure enables superior tax efficiency through in-kind redemptions. Mutual fund structure facilitates certain types of automatic investing more naturally. These structural differences, not marketing labels or brand names, create the real distinctions affecting your taxes, costs, and investment experience. This decision carries greater importance in 2025 for three key reasons. First, the cost gap has widened. ETF expense ratios continue falling. Some broad market ETFs charge only 0.03% annually, while many mutual fund fees remain elevated. Average actively managed mutual funds still charge 0.8% to 1.2%, with some exceeding 2%. Second, tax efficiency matters more as wealth grows outside retirement accounts and more investors reach higher tax brackets. Third, the explosion of investment options means structural differences matter more than strategy differences. You can access virtually any investment approach through either mutual funds or ETFs, making the delivery structure the critical decision factor. Performance ultimately determines wealth-building success. Current 2025 data reveals surprising insights, but we must examine both mutual fund versus ETF performance and active versus passive strategy performance. The second comparison drives long-term wealth creation more than the first. We'll analyze both datasets, but focus particularly on active versus passive results, where the most significant insights emerge. Indian equity mutual funds delivered impressive 17.67% average returns in the first half of 25. Top performers concentrated in mid-cap and small-cap categories, with some exceeding 30% returns in 6 months. Specific examples include the Helios Mid-Cap Fund, with 16.38% quarterly returns, Motilal Oswal Active Momentum Fund at 14.29%, and Mahindra Manulife Value Fund delivering 11.94%. However, broader perspective reveals concerning patterns. SPIVA data shows 74% of actively managed mid- and small-cap funds underperformed benchmarks in 2023. Large-cap funds saw 52% failing to beat benchmarks. While some funds deliver spectacular returns, most do not. The critical challenge lies in identifying winners beforehand, rather than after exceptional performance periods. This pattern continues into 2025, where even during strong overall mutual fund performance years, most individual funds still fail to beat their designated benchmarks. Global ETF performance tells a growth and solid return story. ETF inflows exceeded $0.9 trillion by mid-2025, representing 25% increase over 24. Specific performance examples are striking. Mirae Asset NYSE FANG Plus ETF delivered 257.47% 3-year returns. Nippon India ETF PSU Bank BEES returned 145.39%, and Kotak Nifty PSU Bank ETF achieved 144.01%. Even broad market ETFs performed solidly across global markets. ETFs provide performance predictability that mutual funds cannot match. Most broad market ETFs track within 0.05% of underlying indices. If Nifty 50 gains 15% annually, expect Nifty 50 ETFs to return approximately 14.9% after fees. S&P 500 gaining 10% translates to S&P 500 ETF returns around 9.9%. No surprises, no manager risk, no style drift concerns. You receive market performance minus small, predictable fees. Active management faces persistent challenges despite occasional star performers. 5-year data shows 85.7% of large-cap mutual funds underperforming benchmarks after fees. 3-year periods see 87.5% underperformance. Numbers worsen over longer periods as fees compound and drag performance. This trend continues through 2025, with market efficiency and rapid information spread, making active manager advantages increasingly difficult to maintain. The statistics only include surviving funds, creating survivorship bias. Poorly performing active funds often merge or liquidate, making remaining active funds appear better than historical reality. When accounting for all funds existing at measurement period beginnings, underperformance rates reach 90 to 95% in some categories. Additionally, the small percentage of outperforming active funds rarely show consistent results. 5-year outperformance often leads to subsequent 5-year underperformance, with persistent excellence being extremely rare. Global analysis reveals regional variations in active versus passive success rates. United States markets show strongest passive advantages due to high efficiency, extensive analyst coverage, and sophisticated institutional participation. European markets present mixed results, with some country-specific active managers adding value, particularly in smaller markets with language or regulatory barriers, creating information advantages. Emerging markets offer active management's best track record. Lower efficiency, lighter analyst coverage, and greater information asymmetries create opportunities for skilled local managers. Currency expertise also provides additional value through hedging decisions and positioning that passive funds cannot replicate. However, cost considerations remain crucial across all regions, with cheapest fund quartiles typically outperforming expensive quartiles over extended periods. Key insights for investment decisions. Past performance doesn't predict future results, but cost patterns persist reliably. High-fee funds continue charging high fees, while low-fee funds maintain low costs, with these differences compounding into massive wealth variations over decades. Choosing active management means betting your manager will join the small minority, delivering consistent outperformance, possible but statistically unlikely, with worsening odds over time. Passive investing through low-cost ETFs or index funds guarantees market returns minus small fees, historically beating most active managers most of the time. Performance gaps between best and worst funds are widening, making fund selection both more important and more difficult. The critical insight for 2025: performance becomes less predictable, while cost and tax efficiency remain completely predictable factors under your control. Investment costs might represent the most important factor determining long-term wealth-building success. Small annual fee differences compound into enormous wealth variations over investing lifetimes. Real calculations demonstrate how seemingly modest 1% annual fee differences can cost over $250,000 over 30 years. Beyond visible expense ratios, hidden costs quietly steal retirement wealth daily without appearing in marketing materials or advisor discussions. Mutual funds cost investors money through multiple channels. Expense ratios represent the most obvious annual fee, ranging from 0.5% to 2.5% for actively managed equity funds. Indian equity mutual funds average 1.8% to 2.2%, while U.S. funds typically charge 0.8% to 1.2%. Index mutual funds cost much less, at 0.05% to 0.2%. These percentages extract money annually regardless of fund performance, positive or negative. Load fees create additional costs as sales charges. Front-end loads of 1% to 5.75% reduce initial investments immediately. A $10,000 investment with 5% front-end load only invests $9,500, with $500 going to sales commissions. Back-end loads of 0.25% to 4% discourage fund exits. No-load funds are increasingly common, especially through direct fund company investing, but millions still pay unnecessary load charges. Hidden costs not appearing in expense ratios include bid-ask spreads, market impact costs, and brokerage commissions when fund managers trade securities. Academic research estimates these hidden costs add 0.1% to 0.5% annually, potentially higher for frequently trading active funds. 12B1 marketing fees up to 1% annually pay for fund distribution and advertising, essentially charging investors to market to other potential investors. ETFs employ much cleaner cost structures favoring investors. Primary costs are expense ratios ranging from 0.03% for broad market ETFs to 0.75% for specialized sector ETFs. Averages are 0.40% for equity ETFs and 0.20% for bond ETFs. Specific examples: Vanguard Total Stock Market ETF charges 0.03%. SPDR S&P 500 ETF charges 0.09%. Invesco QQQ Trust charges 0.20%. Trading costs include brokerage commissions, now typically zero at major brokers for ETF trades, plus bid-ask spreads of 0.01% to 0.5% depending on ETF liquidity. Crucially, you only pay trading costs when actually trading, unlike mutual funds where hidden trading costs accumulate continuously as managers trade within funds. ETFs have no load fees or 12B1 marketing fees, transparent pricing with no hidden surprises. 3 scenarios with identical $100,000 initial investments, 7% annual market returns over 30 years, differing only in fees, reveal dramatic wealth differences. Scenario A: high-cost active mutual fund with 1.5% expense ratio grows to $432,194 after paying $197,806 in total fees over 30 years, nearly $200,000 in fees alone. Scenario B: low-cost index mutual fund with 0.5% expense ratio reaches $574,349, paying $93,651 in fees, $142,155 more than the high-cost fund from identical underlying investment strategies. Scenario C: low-cost ETF with 0.05% expense ratio achieves $761,225, paying only $17,775 in fees. The difference between high-cost mutual fund and low-cost ETF, $329,031 additional wealth from same initial investment and market returns, with only fee differences creating this massive disparity. Actual fund comparisons make impacts concrete. Indian examples: ICICI Prudential Blue Chip Fund charges 2.01% expense ratio, while UTI Nifty Index Fund charges 0.10%. Investing Rs 10 lakhs, $12,000 with 10% annual returns shows approximately Rs 47 lakhs, $57,000 difference over 30 years, favoring the lower cost option. U.S. examples: Fidelity Magellan Fund at 0.52% expense ratio compared to Vanguard Total Stock Market ETF at 0.03%. A $100,000 investment over 30 years with 7% market returns creates approximately $142,000 difference, favoring the ETF. These aren't hypothetical scenarios. Real funds with real fees affecting real investor outcomes, with most investors unaware of long-term fee impact. Mutual fund costs remain elevated due to different business models. They pay substantial financial advisor commissions, spend heavily on marketing and advertising, maintain complex operations with customer service and sales teams. ETFs benefit from economies of scale and simpler operations, typically just tracking indices without analyst teams or portfolio managers, minimal advertising reliance on low costs for attraction. Behavioral factors also maintain high mutual fund fees. Many investors focus on past performance rather than costs when selecting funds, allowing high-cost funds to charge premium fees during good performance periods. However, performance persistence is rare, while cost persistence is guaranteed. Funds charging high fees this year will charge similar fees next year, regardless of performance outcomes. Warren Buffett's famous 2007 bet perfectly illustrates cost impact. He wagered that a simple, low-cost S&P 500 index fund would outperform a portfolio of hedge funds over 10 years. The 2017 results: index fund returned 7.1% annually, while hedge funds averaged only 2.2%. The difference wasn't intelligence or sophisticated strategies, it was costs. Hedge funds charged 2% management fees plus 20% of profits, completely consuming any skill advantages. Buffett's lesson? In investing, fees you don't pay become returns you keep. Simple but profoundly powerful for long-term wealth building. Tax efficiency potentially impacts long-term wealth more than fees, yet 95% of investors ignore it until too late. Mutual fund versus ETF structures create dramatically different tax consequences, with ETFs providing over 1% annual after-tax return advantages. For wealth building outside retirement accounts, most investors' reality, tax efficiency becomes absolutely critical. Understanding how mutual funds create unexpected tax problems and how ETFs solve them through brilliant financial engineering can add hundreds of thousands to lifetime wealth. Mutual funds create three types of tax obligations: dividend taxes on fund distributions, capital gains taxes when you sell shares, and capital gains taxes on fund distributions even when you haven't sold anything. The third category creates the most problems and surprises. When mutual fund managers sell stocks at profits, they must distribute those capital gains to all current shareholders by law, regardless of when shareholders bought in or their personal situations. This creates absurd scenarios. Investors buying funds in November receiving large taxable distribution bills in December for gains occurring before they invested. People owing $5,000 in taxes on funds that lost money during their ownership periods. You cannot opt out, defer, or control these distributions. Fund manager decisions create your tax bills regardless of your investment performance or personal circumstances. ETFs solve tax problems through in-kind redemptions, brilliant financial engineering. When large institutional investors redeem ETF shares, they receive actual stocks instead of cash. ETFs choose which specific stocks to transfer, typically selecting those with lowest cost basis, biggest unrealized gains. This process transfers tax burdens to redeeming institutions, often tax-exempt pension funds or endowments, essentially making taxes disappear. Individual ETF shareholders never receive taxable distributions through this process. ETF cost basis gets reset, potential tax liabilities transfer away, and you only pay capital gains taxes when personally deciding to sell shares. This isn't a loophole, it's how ETFs are designed to operate legally, creating superior tax efficiency compared to mutual fund structures. Academic research consistently shows ETFs providing approximately 1.05% higher after-tax returns annually compared to similar mutual funds. Using previous examples, $100,000 invested over 30 years at 7% returns, mutual fund reaches $761,225, while ETF with tax advantage achieves $873,824, an extra $112,599 from tax efficiency alone, additional to any cost savings. For high-income investors in 37% federal plus state tax brackets, approaching 50% total, the 1.05% advantage easily becomes 1.5% or 2% annually. Someone investing $500,000 over 30 years in high tax brackets could gain over $800,000 from tax efficiency alone. These aren't theoretical benefits. Real dollars staying invested instead of going to taxes, compounding for decades into substantial wealth differences. Tax advantages vary globally. In India, equity ETFs and mutual funds face identical tax rates: 15% short-term, under 1 year, or 10% long-term, over 1 year, on gains above Rs1 lakh annually. Indian ETF advantages come from fewer taxable distributions rather than different rates, providing tax deferral and control over timing. US and European markets show more pronounced ETF tax advantages. Mutual funds often make substantial annual taxable distributions, while ETFs rarely make any. U.S. mutual funds might distribute 3 to 5% of value as taxable gains annually, while equivalent ETFs distribute zero, saving high-income investors thousands in annual taxes. Important change. Indian debt investments saw tax treatment modifications in 2023. Debt ETFs now face marginal tax rate taxation regardless of holding period, same as debt mutual funds, reducing ETF advantages specifically for bond investments in India. Concrete portfolio example: $50,000 each in mutual fund and ETF tracking the same index, both earning 8% annually over 20 years. Mutual fund distributes average 3% annually as taxable gains. At 22% tax bracket, you pay approximately $330 yearly in unwanted distribution taxes. ETF distributes zero annually until you sell. Over 20 years, you save $6,600 in taxes from avoiding unwanted distributions, plus compound growth on that saved money. When compounding tax savings at 8% annually over 20 years, total benefit exceeds $15,000 from a $50,000 initial investment, a 30% wealth bonus solely from tax efficiency. This explains why sophisticated investors use ETFs for taxable accounts, while reserving mutual funds for tax-sheltered retirement accounts, where tax efficiency doesn't matter. Investment behavior often matters more than strategy optimization. The best investment approach becomes worthless if you cannot maintain it consistently. Choosing between ETFs and mutual funds often depends on whether you benefit more from flexibility or automation. Research shows average investors significantly underperform their chosen funds due to buying high, selling low, panic decisions during downturns, and performance-chasing behaviors. ETF flexibility can be your greatest asset or worst enemy, depending on personality and discipline. Mutual fund automation can provide success-enabling training wheels or growth-limiting constraints. ETFs provide extensive control and sophisticated capabilities. You can trade anytime during market hours at known prices. Advanced order types include stop losses for automatic downside protection, limit orders for precise entry prices, and good till canceled orders remaining active until executed. Sophisticated investors can use margin accounts, short selling, and option strategies for hedging or income generation. Flexibility enables valuable strategies, tax loss harvesting throughout the year by selling losing positions to offset gains elsewhere, potentially saving thousands annually in taxes. Precise portfolio rebalancing when allocations drift from targets due to market movements, tactical adjustments based on economic conditions or sector attractiveness. However, flexibility creates behavioral dangers. Academic studies show frequent traders earning 2 to 3% lower annual returns than buy-and-hold investors. The ability to trade anytime becomes temptation to trade constantly. Investors checking ETF prices multiple times daily often make emotional decisions, destroying long-term returns. March 2020. Market crash examples. Many sold everything at bottom, then bought back at higher prices months later. Mutual funds excel at behavioral modification through automation. Indian SIPs start with Rs 100 monthly, U.S. automatic plans with $25, $50 monthly minimums. Money automatically transfers from bank accounts and invests at current NAV prices. Dividends automatically reinvest. No decisions required after initial setup. This automation forces dollar cost averaging, buying more shares when prices are low, fewer when high, reducing average cost per share over time. Research demonstrates superior outcomes for systematic investment plan users compared to those attempting investment timing. Automation removes emotion entirely from investment decisions. Target date funds automatically adjust stock-to-bond ratios as you age. Balanced funds maintain desired allocations through automatic rebalancing. Goal-based funds adjust for specific time horizons and objectives. Beginning investor success stories are common. Set up SIPP. Ignore market news for years. Become amazed at accumulated wealth. No market timing, performance chasing, or emotional decisions. Just consistent, patient investing, compounding over decades. Automation serves as powerful behavioral modification, preventing wealth-destroying mistakes most investors make. ETF automation capabilities now match mutual fund features through modern platforms. Robo-advisors like Betterment, Wealthfront, and Vanguard Personal Advisor Services use ETFs exclusively while providing complete automation. Recurring bank account transfers automatically invest in chosen ETF portfolios. Automatic rebalancing when allocations drift from targets. Automatic tax loss harvesting, continuously seeking tax reduction opportunities. Traditional brokers like Fidelity, Schwab, and Vanguard offer automatic ETF investing programs similar to mutual fund SIPPs. The primary difference: mutual funds build automation into products themselves, while ETFs require platforms or brokers providing automation layers above the ETF structure. Automation advantages of mutual funds are disappearing, but not completely eliminated for investors wanting simplest possible setup with fewest moving parts. ETF flexibility provides meaningful value when used skillfully rather than frequently. Tax loss harvesting saves thousands annually for high-income investors through systematic loss realization, offsetting gains. Precise portfolio rebalancing maintains exact target allocations when market movements create drift. Tactical asset allocation allows knowledgeable investors to adjust exposure based on economic cycles and valuation metrics. Advanced strategies include hedging with short sales or options, pairs trading, sector rotation techniques. These benefits require three critical elements: knowledge to implement strategies correctly, discipline to execute systematically rather than emotionally, and time to monitor and manage portfolios actively. Most investors lack one or more requirements, making flexibility create more mistake opportunities than value creation possibilities. Determining whether you benefit from flexibility or automation requires brutal honesty about behavioral tendencies. Key questions: do you check investment accounts more than monthly? Have you sold investments due to scary market news? Do you try timing purchases based on market conditions? Have you stopped investing during downturns waiting for improvement? Do you research economic cycles and market valuations? Have you successfully implemented tax loss harvesting or tactical allocation previously? Most people overestimate investment knowledge while underestimating behavioral biases. Investment industry makes flexibility sound appealing by creating sophistication and control feelings. However, sophisticated doesn't always mean profitable, and in control doesn't guarantee success. Research clearly shows systematic, automated approaches generally produce better long-term outcomes than active portfolio management attempts, even when active managers possess superior investment knowledge. Be honest, answering yes to emotional decision questions and no to knowledge questions suggests mutual fund automation will likely produce better results than ETF flexibility. Optimizing for success rather than sophistication represents the wisest approach for most investors. The active versus passive debate has evolved significantly beyond simple ideological positions. 2025 brings more data, sophisticated analysis, and surprising developments, changing how intelligent investors approach this choice. Historical narrative was straightforward. Passive index funds consistently outperformed most active managers after fees, making passive investing the obvious choice. However, 2025 introduces active ETFs with lower fees and superior tax efficiency, factor-based investing. Splitting the difference, AI-enhanced strategies, and alternative approaches defying traditional categorization. Money flows reveal investor preferences better than expert opinions. June 2025 alone saw $59.98 billion flowing into index funds, while $25.08 billion flowed out of active funds. This decade-long trend shows consistent money movement from active to passive strategies. However, flows aren't simply moving from active mutual funds to passive mutual funds. They're moving from active mutual funds to passive ETFs and increasingly to active ETFs. Active ETF assets grow 20 to 30% annually, suggesting investors aren't abandoning active management entirely, but rejecting traditional mutual fund structures for active management. They want potential outperformance delivered through more cost-effective, tax-efficient wrappers. Geographic patterns vary. U.S. passive dominance is most pronounced. European results are mixed. Emerging markets still attract active strategy flows, particularly local currency and sector-specific approaches. Specific areas show consistent active management value addition. Emerging markets lead examples due to lower informational efficiency, fewer analyst coverage, greater regulatory complexity, and opportunities for local knowledge advantages. Active emerging market equity managers outperform benchmarks in approximately 60% of 10-year periods, compared to only 15% for U.S. large-cap managers. Information asymmetries and market inefficiencies create real skill opportunities. Fixed income represents another active management strength area. Credit analysis skills matter when choosing between corporate bonds with different default risks. Interest rate positioning and duration management add significant value during rate cycle transitions. 2022's interest rate shock demonstrated skilled bond managers positioning for rising rates significantly outperformed passive bond indices. Real-time duration, credit quality, and sector allocation adjustments provided genuine value. Alternative strategies showcase active management at its best. Long-short equity strategies profiting in both rising and falling markets. Absolute return strategies generating positive returns regardless of market direction. Tactical asset allocation moving between asset classes based on valuations and economic conditions. These strategies require active decision-making that passive approaches cannot replicate. Overall active management performance remains challenging despite pockets of success. 2022-2025 data shows 85.7% of large-cap active funds underperforming benchmarks over 5-year periods. Mid-cap and small-cap developed market performance is worse, exceeding 90% underperformance in some categories. International results are mixed but challenging. 75% European equity fund underperformance over 5 years, approximately 8% in Japan, roughly 60% in emerging markets where active management should theoretically have advantages. Survivorship bias makes these statistics actually understate underperformance. Numbers only include funds surviving entire measurement periods. Poorly performing active funds often merge or liquidate, making remaining universe appear better than historical reality. When researchers account for all funds existing at period beginnings, underperformance rates reach 90 to 95% in some categories. Timing elements complicate analysis. Small percentages of outperforming active funds often do so inconsistently. 5-year outperformance frequently leads to subsequent 5-year underperformance. Persistence of excellence is rare. Manager turnover adds risk layers. Identifying skilled active managers doesn't guarantee they'll remain in place or maintain approaches. Factor-based investing, or smart beta, represents fascinating middle ground between active and passive approaches. Instead of individual stock picking or market timing, factor strategies systematically overweight characteristics, historically providing higher returns or lower risk. Value factors, buying cheaper stocks based on valuation metrics. Momentum factors, buying outperforming stocks while avoiding underperformers. Quality factors, focusing on strong balance sheet companies with consistent earnings growth. Low volatility factors, buying lower price fluctuation stocks. Results are mixed but promising in specific areas. Value tilts provided higher long-term returns, but can underperform growth strategies for extended periods. Quality factors delivered more consistent results with lower volatility than broad market indices. Low volatility strategies successfully reduced risk, sometimes at return costs. Most factor strategies are now available in both mutual fund and ETF formats. With ETFs typically offering lower fees, and better tax efficiency for identical underlying factor exposure. Market efficiency varies dramatically globally, directly impacting active management success probability. Highly developed markets like US, UK, and Germany feature rapid information flows, extensive analyst coverage, and high institutional ownership, creating very efficient markets, making consistent mispricing identification extremely difficult for active managers. Emerging markets like India, Brazil, and Southeast Asian countries offer more active management opportunities. Greater information asymmetries, lighter analyst coverage, and regulatory complexities can create advantages for managers with local expertise. Data supports this. Active management success rates in emerging markets reach 40–50% compared to 10–20% in developed markets. Language barriers, regulatory knowledge, and local relationships provide real edges. Currency management importance increases in international investing, where skilled managers can add value through hedging decisions and positioning that passive funds cannot replicate. Even in markets where active management shows better success rates, choice between mutual fund and ETF structure remains important, with active emerging markets ETFs typically offering same manager skill with superior tax efficiency and lower costs than mutual fund versions. Comprehensive analysis, adjusting for fees, taxes, and transaction expenses, shows only 10,000 to 15% of active managers consistently adding value after all costs over 10+ year periods. Choosing active management provides roughly 1 in 8 chances of beating low-cost passive alternatives. However, crucial insight emerges. Even when active management does add value, it's often delivered more efficiently through ETF structure than traditional mutual fund structure. Practical recommendation: most investors benefit from core holdings of low-cost passive investments, preferably in ETF format for tax efficiency, combined with selective active exposure in areas where active management demonstrates best track records. That selective active exposure should probably be in ETF format too, capturing any manager alpha while minimizing structural disadvantages of traditional mutual fund wrappers. Investment industry evolution accelerates in 2025, changing mutual fund versus ETF landscapes in ways most investors don't recognize. These innovations influence investment decisions today and future years. Understanding current trends helps predict where the industry moves and which structures provide better long-term positioning for wealth-building success. Active ETFs represent 2025's biggest investment story, growing 20–30% annually. New SEC regulations allow active ETFs maintaining semi-transparent holdings, protecting investment strategies while providing ETF tax benefits. Major mutual fund companies launch ETF versions of successful, actively managed mutual fund strategies. Fidelity, T. Rowe Price, and Capital Group introduce active ETFs mirroring popular mutual fund approaches, giving investors proven active management access with ETF benefits, intraday trading, tax efficiency, and typically lower expense ratios. Interesting development. Many active ETFs charge lower fees than mutual fund counterparts. Fund companies might charge 0.85% for mutual fund versions, but only 0.65% for ETF versions of identical strategies. This fee arbitrage drives assets from mutual funds to ETFs, even when underlying investment strategies remain identical. The trend suggests investor preference for ETF structure benefits regardless of management approach. 2025 sees massive cryptocurrency ETF developments. Bitcoin ETFs launched in 2024 gathered enormous assets. Ethereum ETFs gained approval and launch, providing regulated access to the second-largest cryptocurrency. Blockchain technology ETFs, AI and robotics ETFs, and other thematic funds focused on digital transformation attract significant investor interest. These developments matter because they attract younger investors to ETFs as first investment vehicles. Millennials and Gen Z investors often start with crypto ETFs or thematic ETFs rather than traditional mutual funds, potentially influencing lifelong investment vehicle preferences. This generational shift could accelerate ETF adoption across all asset classes and investment strategies. Environmental, social, and governance investing has matured significantly in 2025. Sophisticated ESG ETFs go beyond simple screening to focus on climate solutions, social impact, and corporate governance improvements. These funds attract individual and institutional investors wanting investment alignment with values while maintaining competitive returns. ESG fund performance data becomes more robust, with some strategies showing competitive returns while focusing on sustainability. This removes perceptions that ESG investing requires return sacrifices. The maturation makes ESG strategies viable for core portfolio positions rather than just values-based satellite holdings. Technology integration reaches new sophistication levels in 2025. Robo-advisors use artificial intelligence for advanced portfolio management, automatic tax loss harvesting, and personalized investment advice. Most platforms use ETFs exclusively due to transparency and cost efficiency advantages over mutual funds. Direct indexing becomes accessible to smaller investors, allowing individual stock ownership, replicating index compositions rather than index fund ownership. This provides enhanced tax efficiency and customization options, typically implemented using ETF strategies as building blocks. Mobile apps offer sophisticated features: automatic spare change investing, goal-based saving, and integrated financial planning. These apps typically use ETFs for easier trading and fractional share investing flexibility. 2025. Regulatory changes make cross-border investing easier and more transparent. New rules require better fee disclosure, helping investors understand true investment costs. Fiduciary standards strengthen, better aligning advisor interests with client interests. Internationally, increased regulator coordination allows easier global ETF access. These regulatory changes generally favor ETFs due to transparency and lower cost structures. And as fees become more transparent and fiduciary standards increase, ETF cost advantages become more apparent to advisors and investors. Innovation trends clearly show lines between mutual funds and ETFs blurring. But underlying structural advantages of ETFs, tax efficiency, transparency, lower costs, trading flexibility, become available across more investment strategies, suggesting continued ETF adoption growth even for strategies traditionally only available in mutual fund formats. After comprehensive analysis of costs, taxes, performance, and behavioral factors, specific recommendations emerge for different investor profiles. These recommendations consider investment amounts, experience levels, and specific situations to provide actionable guidance rather than generic advice. Your investment approach should match your knowledge level, behavioral tendencies, and financial circumstances for optimal long-term success. For investors starting with less than $10,000, recommendation favors low-cost index mutual funds, despite ETF advantages discussed throughout this analysis. Beginning investors benefit more from automatic investing features than cost and tax advantages of ETFs. Ability to start SIPs with R-Zone 100 in India or $25 in US, with automatic monthly investments from bank accounts, removes behavioral challenges and forces good investing habits. Specific recommendations: Total Stock Market Index Fund for equity allocation, Target Date Fund for retirement investing, International Index Fund for diversification once assets accumulate. Keep initial choices simple, maximum 2 or 3 funds. Focus on building consistent investing habits rather than optimizing cost or tax efficiency at this stage. The automation prevents emotional decision-making that destroys most beginning investor returns. Once accumulating $10,000 to $100,000, transition to ETF-based portfolios becomes appropriate. At these levels, cost and tax advantages of ETFs become meaningful in dollar terms, And you presumably developed some investing discipline through initial mutual fund success. Recommend core satellite approach: 60 to 70% broad market ETF, 20 to 25% international developed markets, 5 to 10% emerging markets, remainder in bonds adjusted for age and risk tolerance. This can be implemented with just 4 ETFs, maintaining simplicity while capturing global diversification. Set up automatic purchases if brokers offer them, or commit to fixed monthly investing amounts. Key is maintaining discipline developed with mutual funds while capturing structural advantages of ETFs. With over $100,000 invested, sophisticated strategies become cost-effective. Tax efficiency becomes crucial at these wealth levels, and you can access best active managers with high minimums. Recommend 80% ETF core with 20% selective active exposure. Use ETFs for broad market, international, and bond allocations. Use active strategies for specific opportunities, emerging markets, alternative strategies, or high-conviction sectors. Implement tax loss harvesting with ETF holdings, selling losing positions to offset gains and reduce taxes. Consider direct indexing for largest positions if available at reasonable costs. Use municipal bonds in taxable accounts for high tax bracket investors. The sophisticated approach requires knowledge and discipline, but can meaningfully enhance after-tax returns. For investors where tax efficiency represents primary concern, high tax brackets, or primarily taxable account investing, go heavily toward ETFs. Use tax-managed ETFs in taxable accounts. Keep any active funds in retirement accounts where tax efficiency doesn't matter. Implement systematic tax loss harvesting. Consider factor-tilted ETFs instead of active funds for strategies like value or momentum investing, where tax efficiency often compensates for any potential active management alpha. For completely hands-off approaches, use target date mutual funds or ETF-based robo-advisors. Target date funds automatically adjust allocations as you age and handle all rebalancing. Robo-advisors provide ETF-based portfolios with automatic rebalancing, tax loss harvesting, and professional oversight. Both remove all investment decisions while providing globally diversified, low-cost portfolios. Choice between them often depends on preference for dealing directly with mutual fund companies versus using technology platforms. Regardless of chosen approach, remember universal principles. Keep costs low because every fee dollar can't compound. Start early and invest consistently because time in market beats timing the market. Diversify globally rather than concentrating in home countries. Keep approaches simple because complexity usually reduces rather than increases returns. Most importantly, the best investment strategy is one you'll maintain through market volatility, economic uncertainty, and changing life circumstances. This comprehensive analysis covered fundamental differences, performance data, cost impacts, tax efficiency, behavioral considerations, active versus passive management, market innovations, and specific recommendations. 4 key pillars emerge for making optimal decisions. Cost matters most over long terms, with small fee differences compounding into massive wealth variations. Tax efficiency provides real value, especially for higher net worth investors. Choose structure based on behavioral needs and capabilities. Both approaches can work with proper implementation and consistency. For most 2025 investors, core ETF portfolio with selective active exposure makes most sense. Start with broad market ETFs for foundation. Add international diversification. Consider factor tilts or active management where it demonstrates best value addition probability. Implement everything systematically with regular investing and annual rebalancing. However, remember that perfect portfolios abandoned during market crashes perform worse than good portfolios maintained through decades. Be honest about behavioral tendencies and choose approaches you'll maintain long-term. Better to succeed with suboptimal structure than fail with theoretically superior approach. The investment strategy you implement consistently over decades matters more than the one appearing best on paper. 5 immediate actions. Calculate current investment costs and tax efficiency to understand starting point. Honestly assess behavioral tendencies and automation versus control needs. Choose 2 to 4 core holdings, matching your profile without overcomplication. Set up systematic investing so good behavior happens automatically. Review approach annually without constant tinkering. Success comes from getting started, maintaining low costs, and allowing compound growth to work over decades. Whether this leads you toward mutual funds or ETFs, the critical factors are beginning early, keeping expenses minimal, and letting time and consistency create wealth. The best financial decision is the one you implement and maintain regardless of market conditions, economic changes, or life circumstances. The choice between mutual funds and ETFs will continue evolving, but the principles of low costs, tax efficiency, consistent investing, and behavioral alignment remain constant foundations for long-term wealth-building success.